I want to bring in Kurt Nelson, founding partner and CEO of Summerhaven Investment Management. Kurt, good morning to you. Happy Wednesday. Just looked at the yen, the impact it's had on the dollar, right? A kind of ripple effect. Wondering if you could help us segue that discussion into the commodities quadrant and products you watch, because it'd be a mistake to ignore the U.S. dollar and the impact it has on markets like gold and crude.
I agree. The interesting fact about commodities is that although they're traded globally, they're almost always priced in dollars. Because the U.S. dollar has the pole position of being essentially the global currency for at least for right now. As a result, if you hold everything else constant and just have the value of the dollar go higher, well, then the price of commodities in dollars should go down. And I think that's quite interesting because we've seen a rally in metals, for example, over the course of this year. And we have seen a correction since the highs in May, but we had this backdrop of a stronger dollar while commodity prices were going higher. And I think that shows the strength of the higher demand and the lagged supply response that supported the rally in commodity prices while the dollar was getting stronger.
So Kurt, it sounds to me like you're saying all things equal in the supply-demand narrative, a higher dollar ultimately weighs on commodity prices. The idea there being that it costs more, right? So you get less bang for your yen or for your euro if you're converting into
That's
dollars.
Right.
Ultimately, you can buy less crude or less gold.
That's right. That's right. I guess the way I would think about it is if a dollar buys, let's say that crude is trading for, say, $75 or $80 a barrel. And the dollar gets stronger, it means the dollar is more valuable. If crude hasn't changed its value, each dollar buys a little bit more crude. It means that the price of crude goes down, right? But if you're buying those commodities in foreign currency, it means that you have to spend a lot more.
All right, let's talk a little bit about crude oil, because we've been not really diving into, but we're going to in just a bit, the higher CPI prices that we've seen in Canada yesterday, Australia today, and crude prices inching up here above 81 as we hold at these kind of stubbornly elevated levels, I feel like.
Yeah, I agree. I think there's been surprises to the upside. I think a resiliency to inflation. And we're seeing it in developed nations in general before we're seeing it, numbers reported most recently out of the U.S. But those numbers are supportive of higher inflation, not of, rate cuts and an easier policy. So I think what we'll see is more extend and pretend as a lot of corporate America hopes for lower rates and a chance to refinance and roll debt at lower rates. But I don't see that in the horizon yet. And we've seen support for crude as conditions seem to be financially tighter.
Labor conditions slowing a bit the economy as well, but not necessarily cratering. I think that supports crude prices here. Talk to me, because again, in that kind of scenario we were talking about, tying it to the U.S. dollar, that balance between supply and demand and everything else, all else equal, that really never plays out, right? Especially in energy markets. There's such a complex environment. What is driving prices right now? Is it the supply side more? Or are you seeing the demand side that's keeping prices at these stubbornly elevated levels?
Well, it's always the nexus, right? It's where supply and demand meet. They can both have, an equal impact on price. I think that what we've seen on the supply side is conviction from OPEC, right? We've seen them reduce supply and generally maintain that and support. It's great for these countries like Saudi Arabia that are incredibly reliant economically on the price of crude to have prices up here in the $70, $80 a barrel level. It's really rough for them when prices get down to $30, $40 a barrel because they're not as diversified in their national income. On the supply side, I think we've still seen a robust demand. We've seen a slowing, maybe of output, but not. So it's not the great years that we had and we're coming out of COVID or maybe pre-COVID, but we're seeing decent GDP numbers coming out of the developed world. We haven't seen the recession that was forecast, prominently by certain economists a couple years ago. And so we're still, using up 100 million barrels a day, in the backdrop of that, with supply still somewhat constrained by support from OPEC, we're seeing, the support for prices where they are, and we're also coming into now the summer driving season. It'd be interesting to watch what happens with unleaded gas. one of the important distillates from crude oil. It tends to have higher demand on a seasonal basis during the summer.
Small build reported from the API yesterday on the close. I was looking at the EIA numbers. They've been kind of just teetering, small builds, small draws, I guess communicating balance. And I would argue price of gas, according to AAA, also kind of signaling that balance right now around $3.49 for a gallon of gas for the national average. Basically, a week ago, $3.44. A month ago, I'm looking $3.59. A year ago, $3.57. So kind of in that sweet spot right now. Talk to us a little bit about gold. What's going on there? Stronger dollar seems to be weighing on it.
Yeah, it has, but I think what's remarkable about gold is that it participated in the rally. Almost all metals did. So gold, silver, but if you look at copper, aluminum, even nickel and tin, you saw this broad year-long rally up to say May, and then you saw a correction in a lot of metals. We've seen copper come down from $5 a pound. We've seen silver correct a bit. Gold has held onto its gains largely as it broke out above 23,000 an ounce. It's a little softer here, but it hasn't really kind of broken out of its lower end of its range, and it's held support better than some of the industrial metals and better than silver. And I think that's encouraging. I think one of the things going for gold is that these tighter financial conditions are going to make it stressful for financial assets like stocks and bonds, credit spreads. And of course, one of the things we've talked about is gold is a great place to preserve wealth. It's a great risk-off asset. And that always comes into play when you see a big sell-off in traditional financial assets. That hasn't really happened in scale, but we're seeing stress in some of the valuations in equities, concentration in just a very small handful of names like NVIDIA, that are supporting index rallies. That kind of concentration of return is a little worrying, and that's supportive of gold. The other metal I think I would highlight that's intriguing is what's happened in tin. It's a less probably followed future market and commodity market, but I think very important in terms of electronics for soldering. Whether it's for electric vehicle production expansion, the renewable energy, solar power, solar farms and the scale that's required there for wind power, and also for chips, related to AI and so on. That tin is pretty essential in that. And we've seen tin rally as much as 40% during that early 2024 rally. And it's kind of held its gains like gold has. So it's still up about 25% for the year. Probably less well known to some of your listeners, but still, important industrial metal that's done well along with gold.
Kurt, lastly, how closely, and we're kind of short on time here, how closely you've been watching the sell-off in beans? It looks like coming back down below the $12 levels we haven't seen since the fall of 2020. Yeah,
I think it's this is critical time, right, for crops, is when we're coming into the harvest period. I think it's going to be really important to watch what happens in weather, whether it's sun, wind, rain. You can have too much or too little. You want Goldilocks, right, as you're coming into the harvest. So I think I would read into those prices an expectation of a quite good crop, quite good harvest. But you have to be careful about counting your chickens before they hatch, to cross an agricultural metaphor. We're not there yet, whether it's in corn or in soybeans. We still have a little work to do before we have all of those in silos or in grain warehouses.
I feel like it kind of just feeds into the trend that we've seen, where if crude oil prices are on the rise, then grains are on the decline, or vice versa. Ultimately, there's been kind of this yin and yang that's been playing out, ultimately helping that balance in the Fed's initiatives to kind of drive inflation back to their target. Kurt, appreciate you joining us to talk commodities this Wednesday morning. Thanks for sharing part of yours with us here on the Schwab Network. That's Kurt Nelson, founding partner and CEO of Summer Haven Investment Management.